Hey, everybody. This is Linda Baumgarten with the Connecticut Real Estate Investors Association and the Fast Track Team Coaching Program. And with me today, I have Kevin Rodman, who is with Asset-Based Lending. They are hard money lenders, and I've asked him to come on board to talk to you about how you can use hard money, how you can use funding, how do you apply for it, how to make sure that you're accepted, and then while you're using it, what's the best use of the money and how to manage the money through your renovation project. So, Kevin, welcome to the call. Thank you for doing this. I know you're a busy gentleman down there, so thank you for being on the call here.
Thanks, Linda, and I really appreciate that you invited me, and I'm very happy to give as much information as I can to your members. So Asset-Based Lending is a hard money lender. We are based in Hoboken, New Jersey, but we lend from Washington, D.C. to Boston. I actually live in Westport, Connecticut, and know the state very well. We have done over $95 million of loans in the last 3 years with over 500 separate transactions. We've also flipped 30 homes ourselves. We have over $50 million in capital, and we have two obligations. We protect our investors' money. Our capital is from investors who invest in our fund. But we also feel it's our obligation to protect our borrowers' money, and we're going to get into that through the course of the presentation. Out of our 500 loans, we've never had to foreclose. We have had 8 deals that are in some stage of trouble. But that's less than 2%. And we think the reason that we've had such a good track record is because we're different than other hard money lenders in that we spend a fair amount of time with every borrower understanding who they are and understanding the economic value in the underlying transaction. Having done over 500 deals, we have a database of what everything costs. We also are very good at identifying what a house should sell for and what it's worth today. And so we have many conversations with our borrowers over what makes sense and what doesn't make sense on a deal. And we're always happy to talk to borrowers anytime about their transactions and what we think works. Examples would be, whether you're over-improving the bathrooms or whether the roof should cost $10,000, not or $6,000. So we can get into that later. So that's who we are. And Linda, turning the page to
Sure.
the next page.
There you go.
Our loans are 1 year in maturity. They are interest only. There are no prepayment penalties. Our smallest loan is $75,000. Our largest is $1.5 million. We lend at 80 to 90% of the total deal costs. That's purchase plus rehab. And we cap that at 60 to 65% of the ARV appraisal. And I want to take a minute right now to give you a simple example of what 80 to 90% means.
Okay.
So let's say you're buying a house for $125,000, and you have, let's make the numbers easier. Let's go with $150,000, and you have a $50,000 rehab. So your total deal costs are $200,000, and your ARV is $300,000. Okay? So let's say on this one we choose to lend at 85%. So we take 85% times 200, which is $170,000. So on that loan, we would lend $170,000. But we would take the $50,000 for your repairs and put that into escrow at a law firm where it's protected for your benefit. But the point is that 100% of your rehab is funded. So then when we come to the closing table, we come with $120,000. That's $170,000, the total loan, minus $50,000.
Hey, Kevin, I pulled up a Word document. Let's just run through those numbers again, okay? So start at the beginning there.
So $150,000 purchase,
okay.
$50,000 rehab,
Okay.
Total deal cost $200,000.
Yeah. Okay.
Okay. Say we choose to lend on this one at 85%. 85% times 200,000 is a loan of 170.
Equals.
Okay.
Okay, so that's the loan amount.
That's the loan amount.
Okay.
$50,000 goes into escrow at a law firm, and that money's protected for our borrowers.
Okay.
Okay, but the key point here is that we want 100% of your rehab to be financed.
Okay.
So that means that we come to the closing table with $120,000.
Okay.
All right. That means you, the borrower, have to bring the difference between the purchase, $150 and $120, or $30,000, plus closing costs.
Okay.
So on a deal like this, we're going to charge, in Connecticut, we generally charge 12%, 3 to 4 points. Let's say you're a high-quality borrower with a great FICO and you have experience, and we charge 12 and 3. So that means we would be charging 3 points on 170.
Okay.
Which is 5,100 in points.
I'm sorry, how much is that?
5,100.
Okay.
And then there's approximately $3,000 in other closing costs. That includes title, appraisal, legal fees on our side, application fee. It's about $3,000.
Okay.
So roughing it out on this deal, you're probably going to need around $38,000 to $40,000 to close. And then we like to see at least $10,000 or $15,000 in the bank beyond your down payment.
Okay.
Okay? So that's an example of a typical deal. Now, on a $170,000 loan, we want the ARV appraisal to be at least $262,000.
I'm sorry, it has to be how much?
At least $262,000.
Okay.
Which is 60.
Plus.
Means our loan then would be 65% of the ARV appraisal.
Okay.
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 All right. So.
Yeah. And the $50,000 you're talking about putting into an escrow, that's for your renovation costs, correct?
That's correct. And
so you have to be able to. So the $10,000 to $15,000, is that designed to get your rehab started?
It is, and to have a little cushion. So what you're going to do as a borrower is you're going to give us a detailed scope of work with line item costs, preferably on contractor letterhead, as part of the underwriting process. And we're going to review that with you, particularly once we get the appraisal. We're going to take a look at the appraisal and then take a look at your scope of work and make sure that it looks like you're covering everything that needs to be covered. Given our experience, we're very good at noticing what things need to be done and where you might be doing things that don't need to be done. Then we're going to take a look at your costs per item and let you know where we think you might be on or off. Let me give everyone an example. Home Depot has a private label brand of Andersen windows that cost $200 a piece. I forget what they call it. But
Silverline, probably.
Yeah, Silverline. It's as good as an Andersen that costs $350. And it typically costs $50 per window to have those installed. So we look for $250 per window in a house that's priced like this house, around $250 to $300. A lot of times, for some reason, we see $400 a window, $500 a window, and we have to have a serious talk with the borrower about what they're doing. That maybe the contractor's buying Andersen, or maybe the contractor's just overcharging. That's just one example. So what we're going to ask you to do with this deal that we're talking about is give us a scope of work. And then with the scope of work, we then ask your contractor to give us a draw schedule. And the draw schedule is going to bucket your bucket your deal into 4 draws, and we are going to give you the money for each draw. In this example, say $12,500 after we inspect. So you're going to be out the money for the first draw, as an example. You call us 3 days. Call us 3 days before the work is complete on draw 1. We send back in the original appraiser. He photographs everything and checks off from your draw schedule, sends it back to us, usually within 24 hours. The moment we get it, we assess it. If everything looks like it's been done to a good standard, we wire the money to your LLC that day. If anything is missing or if the work isn't done well, then we call you and we talk about it. It's fine if you decide to do something from draw 2 and mix it with draw 1, but we generally want a heads up about that, and an example might be that you put in the bathtubs rather than just do the rough demolition. So going back, Linda, one page on paperwork, individual.
Sure.
I think you're at paperwork property.
Correct. 1 second. Yeah. There we go.
Okay. Paperwork individual. So we have a standard loan application. We do some income and asset verification, but not much. We like you to fill out an application that shows your assets. We want to see 2 months bank statement and last year's tax returns. We are going to pull your credit, and if you have other members of your LLC, we're going to want them to be co-guarantors. We only lend to non-owner occupied homes that are placed in LLCs, and that's standard for all hard money lenders. We do no owner-occupied properties.
So non-owner occupied has to be owned by an LLC or some other entity like that. Okay.
Yeah, corporation, S corp, just can't be an individual. And
so let me ask you a question. So when you approve the individual, and say we do 3 to 5 rehabs a year, do you need a new application every time we apply for money?
No. In fact, over 35% of our book, 200 loans right now, almost 70 loans are repeat borrowers. And one of the reasons they come back to us so often is because once you've done one loan, the next loan is really streamlined. Our average closing time is 2 weeks. With repeat borrowers, our average close is usually a week. The only thing that ever slows it down is title. We don't need a new application. We refresh credit every 6 months, and everything else. And we only need recent bank statements and then get an appraisal and title. If the deal looks like it makes sense, scope of work, draw schedule, and we close.
Okay.
We do pull your credit. We are not FICO score driven, but we do want to understand your history of paying your bills. Our average FICO is a 680 in our book right now. But we see a lot of people in the 7s, and we see a lot of people in the 6s. We even see some people in the 5s. And when we're not adverse to lending money to people who have seriously impaired credit, but we need to understand why, and we need to know, when you haven't paid your bills, why, and we need to hear the story. And so it's an open discussion. It's not a bright line test when it comes to credit. If somebody's credit is in the mid to low 5s, sometimes we ask to bring in a co-borrower, and so it's for each individual and for each deal. It's a unique discussion. A lot of people from the Connecticut RIA call me after I speak and say, "What do I need to do to be pre-qualified?" And we don't do pre-qualifications. The reason we don't is because things change over time, and also we're mostly about the deal. We definitely want to be comfortable with your credit, but I would say 60 to 70% of our underwriting process is making sure you have a profitable deal, and 30% is about your credit. if if you call me, in fact, after I spoke just a few nights ago at the Connecticut RIA, a couple of members called me and wanted to be pre-approved. I said, "What's your FICO?" They both said 700. I said, "Well, you're approved." On a that's a good credit score. From a credit counterparty credit basis, that's fine. But then we want to make sure you've got money in the bank, and your deal makes sense. And that's why we won't do a firm pre-approval until we see that. We often get asked to do proof of funds letters, and we do many of them for a number of the Connecticut RIA members. We charge $250. We charge $250 for an unlimited number of proof of funds, and we credit the $250 towards your deal costs when you do a deal with us.
So let me jump in on that one. So what happens is, especially if you're making offers on short sales or REO properties, bank-owned properties, you may put in 10 offers, but only one of them gets accepted because of the way the bank process is. So what they're going to be looking for is, can you actually close on the deal if you do get accepted? Because banks get ornery, and so do the realtors if they do all this work to approve your offer and then you cannot close on it. But on the other hand, how do you keep all this money lying around for 6 months to a year till the bank decides they want to accept your offer? So what Kevin is saying is that asset-based lending will write up a letter saying, yes, you've been pre-approved for proof of funds. Yes, we have this amount of money for the project, and he can do an unlimited number of those so that you can keep on putting in offers. You invest $250 with them, which is a great deal, and then that $250 is credited toward the loan when you actually do get accepted on the offer. So that's a great service.
Yeah. I need to point out something really important to everyone on the phone. A third of our deals are REO, bank sales, short sales, and Fannie Mae liquidations. And 8 times out of 10, our borrowers make a mistake when they're bidding on those. And the mistake is you have to bid in the name of your LLC, not in your personal name. Because the sellers of REOs, the banks and Fannie Mae, don't want you flipping it and making a profit on the day you close. So they have restrictions often in the sale contracts that say you can't transfer within 90 days. And it's hit or miss because we only lend to an LLC. If you've bought a Fannie Mae property in your own name, I would say 7 times out of 10 that kills the deal, because Fannie Mae won't let you change it to the name of your LLC. So really important that everyone, you bid in the name of your LLC. Really important.
Okay, great.
Okay, so keep an eye out for that. Turning the page to paperwork.
Sure.
Property.
There you go.
Okay, so pretty straightforward. We need to see a purchase contract that's been executed and any addendums. The appraisal, we order. We have a number of appraisers in every jurisdiction in which we lend. In Connecticut, we have an appraiser that does Fairfield County. We have New Haven County, and a different appraiser, and then we have an appraiser for the Hartford area. 3 different appraisers for the state. And so when we send you a term sheet, if you like the terms, we then order the appraisal. You have to meet the appraiser, and with your scope of work, the appraisal is done as an ARV, after repair value, as if you were doing the work to at least a mid-grade standard, and you have to pay the appraiser on site. A standard single family in Connecticut is about $350. Multifamily 2 might be $500, and a 3-family $600 to $650. And I failed to mention in the beginning that we do single family, we do multifamily. The largest we've done in Connecticut is a 6-family building. We've looked at 10 and 15 family buildings. We also do mixed use. We see those occasionally in Bridgeport and Hartford.
Okay, good.
So that's the appraisal process. It typically takes us 3 days to get the appraisal back. As soon as it comes back, we analyze the report.
Hold on one second. Let me just mute somebody out here. Go ahead.
So we look for some really important things in the appraisal, and our appraisers know exactly what we're looking for, so they're always usually spot on. We want to make sure the comparisons, the comparable properties, are within a mile. Sometimes that gets difficult in the slightly more rural Connecticut towns. And we often stay away from the very rural places because there just aren't enough comps. And that means we really don't do much in Litchfield County. We don't do much in the western fringe of the state. And northeast and around the casinos also, it's difficult to get good comps. So the comps have to be within a mile, 2 miles max. The houses have to be similar. For instance, we're not going to compare a ranch to a 2-story center hall colonial, obviously. And we look, most importantly, in our business for days on market. We want to make sure that the days on market for the comps are under, we'd like it to be under 90, but it's often under 120 to 150 days. And that's not only important for us, it's important for you, because you don't want to get stuck with this property paying our 12% interest for an excessive period of time.
Right. So you know, at first, sometimes you feel like this process, you want to consider the hard money lender to be your partner, because just as badly as they want to get their money back out, you want to get your money back out also. So if they don't like the deal, I would definitely listen to them and not try to go do it on your own. There's, these guys have a lot of experience, and there's a reason why they say what they say. So.
Yeah. Thanks, Linda.
Sure.
We also want to see a clean title report. Title often holds up deals. It's very important that as soon as it looks like we have a deal, that you have a purchase contract and the appraisals come in good, that you order title. A lot of times borrowers, if they're confident that the appraisal is going to come in, they order title in advance. That's a little risky for you because it costs money. But if there's a problem with title, it often delays the deal. And then I've already spoken about scope of work and draw schedule, and then insurance. So we require what's called builder's risk insurance on something that's called special form. That's capital S, capital F. Special form means that the property is insured for hurricanes, wind, flooding, and all kinds of fires, whereas non-special form does not protect against that. And if you take a look at how things get damaged, in fact, hurricane wind and flood are the things you really care about more than anything else. So we always require special form. We have a insurance agent that we have no business, that we don't get paid by them. They don't pay us, but they know exactly what we want. They're recommended in our term sheets. Our borrowers are free to use their own insurance agent or use the one we recommend. I would say 7 times out of 10, when a borrower is using their own agent, they don't come with special form, and the insurance has to be redone. So now that we've gotten the appraisal, I want to mention something. We do something unique at ABL that I think a lot of our competitors don't do. The most important thing for us in terms of managing our risk, besides making sure you've got a good deal, is, number one, you bringing some skin in the game. We want to see you having some money at risk. Like in the example I showed before, you've got to come with $30,000 to $40,000. But as important, we want to make sure that you're making a profit on the deal. So we have a spreadsheet that calculates your profit, and we're happy to share it with you. And it's very simple. It's not precise. It's within $5,000. But we will calculate what we think your profit is. And we like to see you making the greater of $25,000 or 10% of your deal costs. So in the example we provided before with a $200,000 deal cost, we would want to see you making $25,000. We make exceptions to that. A lot of times the appraisals might be conservative. Our borrowers might be very confident that their realtor is telling them it's going to sell $10,000 or $20,000 higher, and we might make an exception if our borrower has experience. If our borrower is our first deal, we're going to be we're going to explain to them what we think the profit is and ask them to, if they agree or not, and get on the same page, because we really don't want to see. It's one of the biggest problems people who are in a deal for the first time make, which is they don't work for enough money because they're so eager to get a deal done. They've bid on so many properties. They finally found one they think that's going to be the deal, and
right.
they work for too little money. And
that's really important, because I know that, when you get trained with us, we show you how to put in a contingency fee, for the things that you can't, an oops factor, so to speak. But that could get used up really easily. So if you're not making at least $25,000, you've got a really, really tight deal. Especially at $200,000. At a $200,000 deal cost, I would think you'd want to make at least $40,000 because of the high cost. If you're buying something at $75,000, that's a bit of a different story. So I think that's great that you guys do that.
Yeah, we don't know any other lenders that do that. We turn a lot of deals down because the profit is too thin. I do want to say, Linda, that obviously you really are expert at this, but most of our deals these days, we don't see 40,000 on 200. We see more like 30,000. But I'm splitting
really?
hairs.
Okay.
Yeah.
Okay. Okay. Good. Well, that's good. Tell them to come to our coaching program. We'll help them out. But seriously, I think
because we have 200 deals on our book right now, but we see 10 or 15 homes getting sold every month. And we track them, and most of our homes are selling 5 to 10% above the appraised amount. But that makes sense because house prices are appreciating at about 6% a year right now. It was actually in the Wall Street Journal today. And it's been 6 to 9 months since the appraisal. So it kind of makes sense. So we do feel pretty good that our appraisals are pretty accurate.
Yes, and again, that's really important. And whether you use asset-based lending or not, you definitely want to get a real appraisal before you borrow money on it anyway, because of what you were just talking about. So, good job. Yeah. And if you don't get accepted, if you don't fit within their profit margin, then you want to go back, and maybe you need to go back to the whoever you're buying the property from and saying, look, I made a mistake and I need to buy it at $10,000 less or $25,000 less, and now you've got an appraisal to back you up. Here's the appraisal that I have. This is what's showing, by the experts. And by the way, we uncovered something that really needs to get fixed that we didn't know about, so that you can get a better deal. Remember, if you're buying stuff from the bank, they need to get rid of these properties as much as you want to buy them. So again, so you can use this as part of your negotiation. So, all right, what about let's talk about the LLC formation documents and all that. How does this all work?
Right, so we require some basic documentation on your LLC. We need to see, it's standard. You can download these from the web or have your lawyer get them for you. The formation document is just a legal document that governs how your LLC was formed. I've realized now I've got something missing on this page. If you have more than one member in your LLC, we need to see the operating agreement.
Okay.
And then obviously, like it says here, the LLC wiring instructions, and we want to see you sign our term sheet, the loan term summary.
Okay.
So next page, what do hard money lenders look for? I think you skipped a page, Linda.
Oh, sorry. There we go.
Yeah, okay. Most important thing is we want to get to know you. So you call in, you tell us about the deal. We want to hear your story. We want you to explain to us the deal, and we want to make sure you sound like you understand the deal and you understand what you're doing. Number two, we've already talked about this at great length. The deal needs to be a profitable deal. Number three, we're interested in your experience. We get a lot of investors who own rental properties but have never flipped, and that's fine. We also do about, I would say, 20% of our book is first-timers, and we're unique in that. We enjoy working with first-timers. As long as you sound smart and you've got cash and you can pay our interest and the deal looks profitable, we're happy to work with first-timers. And we've had a good experience. I am, when I get to the end of this page, going to talk about war stories that I'd like to just bring up with that have happened to us with first-timers that are do's and don'ts. So, experience, exit strategy, really important. What's your plan for the property? Most of our borrowers are in a fix and flip mode, but more and more lately we have borrowers who say they want to hold it as an investment property. So when we hear that, we're a little bit more cautious because we want to know we're getting our money back in a year. And we'll also do a little work with you to make sure that you're bankable. What bankable means is that you're going to be able to get a bank loan at the end of a year and pay us off. Most banks have a lower LTV for a permanent financing than we have. So you might have to come up with some capital if you're intending to retain the property. Continuing with what we're looking for, we want to know how much cash you have to invest. We already went over that on the sample deal. We want to understand your income. If you have a W-2, we want to see it. Most of our borrowers do not have a W-2. Most of them are professional real estate investors or contractors that somehow magically don't show a lot of income but do have cash flow, or in some other business that gives them cash flow but don't show income. And then, as we've already spoken, we're going to look at your credit and talk to you about your credit. So that page is really important that we're talking about now. That is sort of summarizes everything we underwrite to do a deal. And our underwriting process is fast. From the moment you call us, we will know within an hour of whether we have a deal to do with you, and then it's let's get an appraisal. If the appraisal comes in good and you show proof that you've got money in the bank, we have a deal. So before we move on to this page, the benefits that Linda just moved to, I'm going to do just quickly some do's and don'ts that I thought was received well the other night at the RIA.
Good.
Do number one, the most important thing you can do is buy your house, buy your property at the right price. That is the single biggest driver of your profitability. You got to buy cheap. Number two, you have to pick an excellent contractor. I can't stress this enough. For all you first-timers on the call, it's the number one mistake that we see first-timers making is you choose a bad contractor. You've got to get 3 references on your contractors, and you have to go see 2 different samples of their work. You have to do it. The number one problem we see is contractors either stealing money or doing bad work with beginners.
Wow.
In terms of the stealing money thing, very important. Do not give your contractor a lot of money up front. Negotiate for as little as possible. Number one, you're going to be out the money because remember, we give you your draw money after we inspect. But number two, we see a lot of contractors stealing the money. So just be careful. Number three.
That includes, by the way, not just actively stealing money, but just buying materials and then using the materials on another job and then telling you they've run out of materials, right? Am I right about that, Kevin?
Happens all the time. All the time. They say, I need $10,000 to buy windows and wood and drywall, and then, lo and behold, it's not there. Can't tell you how many times it happens to a first time. You really, the third most important thing is to have a cash cushion, and Linda, thank you, you've already said that.
Yep.
Some things that we think you shouldn't do, and I've already said it. Number one, don't give a contractor a lot of money before the work is done. Number two, we don't think you need to use a loan broker. There's a lot of very unscrupulous loan brokers out there, and they're going to take fees from you and application fees. There might even be somebody that holds themselves out as a lender that you've somehow found on the web. That's not really a lender, that's a broker. So you need to do your homework. You need to find out if they're a direct lender. And we don't think you need a broker. The advantage of a broker is if they're a good broker, they might know a dozen lenders and make life easier for you. The disadvantage is they're probably going to charge you 2 points or more. We don't allow our brokers to charge more than 2 points. The reason we have that restriction It hurts us in business because we don't get a lot of broker business because of it, but we don't think you as the lender should be paying our points and 3, 4, 5, 6 points to a broker. We just don't think it feels good. We don't think it's healthy for you, and we think it actually speaks of desperation on the borrower's part because you shouldn't be paying that much in fees. The last thing that's a piece of advice where we've seen problems is know your partner. If you have a partner, you need to really trust them. We have 2 or 3 deals in our book right now that are in default, and it's because one of the partners was a bad guy. So, and when I said this actually at the RIA on Monday night, I actually saw 2 or 3 people shaking their heads that obviously had experience with a bad partner. And so if you do have a partner, make sure you both have to sign something to move money and things like that. Don't ever give somebody signing rights to move your money.
Excuse me, Kevin. Can you still see my screen from your side?
No, I see a start meet thing.
Oh, you do? Okay. All right.
Yeah.
Because somehow I've lost the tab for the meeting, but you can, all right, so if I go back here from current slide, from current slide. All right, so you can see benefits of working?
Yep, I see that.
Okay, good. Beautiful.
So the benefits of working with a reputable hard money lender like us, for beginners, we'll do a deal with you. You know, and a lot of other lenders might not do a first-timer. For experienced investors, we can do a lot of deals. We currently will do up to $1.5 million with any individual experienced investor. We've got several right now that have 6 or 7 deals at a time. We're a reliable source of funds. We don't back out. We don't run out of money. We often, once a month, we get a deal that somebody was working with a private lender, and oops, 4 days to go, private lender backed away. They ran out of money. A lot of private lenders don't have the type of capital that we have. And as long as they've come with title and appraisal and the deal makes sense, we close those deals. We did a deal in record time last week. We did a deal in 3 days.
Wow.
And it was with a private lender backed out. The borrower came to us, and we got it done. We were proud of it. And then we've already covered these points that we've made on this page.
Okay.
We've got a lot of experience. We can help you, and we also know contractors and other service providers. How to select a hard money lender? You need to find someone that we think is looking for a relationship. Then do they take the time to educate you and help you like we do? I think there are other hard money lenders out there that are kind of loan to own, which is a term that's used in the business, which means that they're kind of indifferent of whether you default or not because they'll be happy taking your property. That's not us. We don't ever want to be in default. We want you to make money, and so be careful who you choose as your lender. You should be careful going with somebody way out of the region. We think it's better to be with somebody in region who knows the area and who has a good reputation locally. And you can ask for references. It doesn't hurt. Say, could you give me the name of 2 or 3 of your borrowers that I can call in my area?
I think that's a really good point, by the way. You know, when somebody is a sponsor of CT RIA, if they, so for example, say asset-based lending didn't do what they said they would do, as a member you would call us, and then we would, not that we take sides, but we would make a phone call, we'd go back to them, and we would gently remind them that they have access to tens of thousands of people through our reputation. So when you're dealing with somebody who has that kind of a relationship, you're a little bit more protected that way. So if you're calling in from another state, I would do the same thing. Call your local RIA, find out who they work with. Does that person do loans in that area? And as you heard Kevin said, he has 3 different appraisers in Connecticut, so those appraisers know about Connecticut real estate, which is really important. Unfortunately, over the last 2 years, I've heard of a lot of bad appraisals that have killed deals because they just didn't even, whatever, they were not comparing apples to apples, and a couple of different things that didn't make any sense at all, and so that can really hurt you. So I think that really makes a lot of sense, Kevin. Thanks for bringing that up.
Sure. Thanks. So I think we've covered the broker page.
Yep.
The advantages, they know a lot of lenders. The disadvantages, they charge you a lot of points. I've even had some borrowers who really have been hurt by brokers, where the brokers are charging them application fees, and then the borrower didn't know it was a broker. Then they get introduced to the lender. The lender charges an application fee. It's really, you really got to, before you get in bed with somebody, have them email you all the fees. Get it in writing.
Cool.
And that's really important. And now with what's available online, you could generally find direct lenders online. But even when you find a direct lender, have the conversation with them and say, do me a favor, email me all your fees. Okay. Next page, what do you do if you have no money? You can flip a property and wholesale it, find an investor, or find a gap funder. And you should check with your lender about whether they allow a second lien for the gap funder to take a second. We at ABL do not allow second liens. If you bring in a gap funder, the gap funder has to be either part of your LLC or have a side contract with you that defines how they're going to get their money back. The reason we don't allow second liens is because in the unlikely event of a default, a second lien holder can hold us up in court, and we don't want that. And that's just the way ABL does business. I think a lot of other hard money lenders are the same.
Gotcha. So if you do bring in some other money, it's either got to be add them to your LLC, or you have an agreement but it's an unsecured agreement, and there's no lien against the property. Okay, great.
That's correct.
Cool.
Okay, the risks of hard money. Our rates are high, and the reason our rates are high is we do three things that banks don't do. Number one, we close fast, average time 2 weeks. Number two, we lend against properties that have been really beat up, mold, fire, really horrible states of disrepair, and banks often don't do that. And the third thing we do, and many of you have great credit, but we lend to people who have a storied past in their credit, and for that reason, we charge a higher rate. But it hurts your profits if things drag on. So you got to really be on top of getting the deal done on schedule. Very, very important for you to manage that. I do want to say something. Of our 500 deals, 90% of our borrowers believe that they're going to get the renovation done in 2 or 3 months and have the house sold in 6 months. And I can say that less than 10% of our borrowers sell their homes in 6 months. Many get the work done in 3 months, but it often takes, today's market is hot, but it can take 30 to 60 days to get a real bidder, get a contract, and then they have to get financing from a bank, and it could take them another 60 to 90 days to get a mortgage to close. Our average loan right now is 8.5 months in terms of until the house is sold. And when you're thinking about your profit, my recommendation is to model 8 or 9 months. Don't model 6 months.
Yeah, let me just jump in on there because, yes, some houses are flying off the market, but there's also others that do not. I've talked to 2 experienced rehabbers. They each have 2 houses, and they're just sitting there with no offers at all. I've talked to a realtor who all of a sudden the phone calls have dried up. So you really, I just want to double underline what Kevin is saying. You've got to plan for that. And as you heard us talk at the anniversary, stage your houses. Can't say that enough. People are looking for the big reveal to be able to sell them. But say you do get it done within 3 months, then, as Kevin said, it takes 30 to 60 days and then to get an offer, and then another 30 to 60 days to close, and then, worst case scenario, the mortgage company backs out. Now you have to find another buyer. So that's a whole other seminar, but you definitely want to have that kind of contingency there. So Great.
Yeah, we have 21 loans out of 200 right now that are extended beyond a year, mostly because our borrowers have yet to capitulate and realize that they're not going to make any money on the deal and lower the price. And
Oh, gotcha.
I don't have a simple explanation for why some of these houses don't move, but if I had to give you one, I would say be careful if the house is ugly. Just be careful. The appraisal might come in and it might look okay, the appraisal, but if a house is ugly, it's ugly. And so those are hard.
If the flow of the house doesn't work, if it's not a typical invest in the houses that are typical for your community, and don't try to be a maverick in this. Just find what is selling. One year in my town, I had the realtor pull up all the houses that sold in my town for 1 year, and then I counted how many of each type of house was the most popular. And surprise to me, the smaller capes were the ones that sold the most. And I was surprised. And quite frankly, I don't like that style of house. But the market said yes. So you might want to try doing that also. So I think we hit on common mistakes. Is there anything else? And then we talked about what to look out for.
Yeah, and we don't believe in 100% funding. So, but we think it. Yeah. Anyway,
cool.
So next page is hard money right for you? The answer is: does the deal make sense? Do you have enough money in the bank? Do you have a cushion? And do you have an exit strategy? If you do, then we probably make sense for you.
Cool.
Okay, next. Private lender.
Should you use a private lender?
Yeah, so there's a lot of private lenders out there. Probably is our number one competition. Private lenders are usually less expensive than a hard money lender by 1 or 2 percentage points. If you do the math, it doesn't really change the overall economics of the deal. So the question you have to ask with a private lender is how much money do they have? They might not tell you the truth. How many borrowers do they have? Are they going to run out of money? And how much of experience have they had? So we have a lot of borrowers who have had great luck with private lenders and a lot who haven't. So you should research that market and research hard money and do what you think is best for your business.
Cool, excellent.
Okay.
Should you find your own investors? Meaning, should you find your own lenders, right? That's what you mean by that?
I mean like your own, sort of capital partners and not borrow money. All I can tell you is we've seen people try to do this, to bring in a number of partners. Invariably, those deals blow up. It's too many cooks in the pot, too many people with different objectives, and it's hard.
Mm-hmm. Cool.
Okay.
Advice.
Yep. Do your homework. I think we've covered everything. Do your homework on the
lender. Yeah, I think we have to.
Before calling. Yep. Come with a purchase contract. Know your numbers. Sounds smart that you know what you're going to make on this deal. Have a plan. Give your numbers to us, and have money in the bank.
There you go.
And that's it.
Do more deals. Cool. Now, somehow I've managed to lose the part that allows me to see who's on the call and who's asking me questions. So if you have a question, you could quickly send me an email to linda@ctria.com. It's linda@ctria.com real quick, and I can answer any questions there. But I think, and then I can forward any questions that you might have back to Kevin. And, here it is. Good. I have it here. Beautiful. Actually, on your chat, if you have any questions, you can send something there. And I'll just unmute people. If you could, I'm going to unmute people, so if you can just watch your conversation, mute your own phone if you'd like. Does anybody have any questions that you'd like to ask Kevin while we have him on the phone? If not, I'm just going to go to this page here. This is Kevin's contact information. Are they talking to you, Kevin, or do you have somebody assigned to CT RIA folks? How does that work when they call in?
We all are partners here at my company, and call our
Okay.
main number, 201-942-9090, and
Okay.
anyone you talk to can help you.
Beautiful. All right, excellent. All right, well, again, thanks so much. By the way, just, a lot of you know Robin Thompson. She spoke here a couple months ago, and she's out of Waterbury, Connecticut originally, and she did, in her 1 year, she did 100 deals in 1 year, and she said her biggest regret was that she did not use hard money sooner, because without having available capital, she couldn't do the number of deals that she wanted to do. So, investigate, meet with the folks at asset-based lending. If it matches your business model, I would go ahead and get qualified as soon as possible and then start making as many offers as possible. And at the same time, sounds like you definitely need to raise money to have in reserves. So you definitely need to have raise some money with some partners for that to happen also. So it's going to be both things. So great. Kevin, any last words of wisdom here?
Nope. Already gave
All right, great.
everything I know. Okay.
Did a great job. All right, everybody, have a great day and afternoon, and we'll talk to you really soon. Have a great day.
Thanks, everyone. Bye-bye.
Bye-bye.